Here in Chapter 9, we have two parts. The first part, Part 1, we're going to take a look at employee expenses, business expenses. And then in the next video, Part 2, we'll take a look at deferred compensation or retirement income. So in the case of business expenses paid by the employee, you first have to identify if there is an employer-employee relationship. Now, many employers will treat their hired so-called employees as independent contractors, and they're going to try to avoid withholding taxes or handling payroll taxes. And that's to the detriment of the employee or the hired party. The IRS, and especially the Department of Labor Industrial Relationships, the so-called unemployment um, income division, is trying to enforce making sure that the hiring parties, employers, treat the hired parties as employees. So you got to follow what they call the Federal Fair Labor Standards Act, enforcing things like minimum pay or overtime hours. And again, also in the case of taxes, making sure they have withholdings. That's both for income taxes, which is coming from, of course, the employee's paycheck, and also payroll taxes like the FICA, um, the Medicare, and the Social Security. And half of that is taken out from the employee's pay, and the other half is matched by the employer. Now, again, a lot of employers don't want to do that. So just subjectively, they treat the hired parties as independent contractors. Yeah, so the IRS is trying to crack down on that. So if you're an employee, you know you're going to have a W-2 form from your employer at the end of the year reporting the amount of wages you had earned or salary and the income taxes, both federal and state, taken out from your paycheck, and also the Social Security and Medicare taxes taken out from your pay that also the employer had matched. So eventually, when you do retire, you can collect the Social Security benefits and get that hospital insurance for the Medicare taxes if taken out of your pay. Now, if you're treated as an independent contractor, you're not going to get a W-2 form from your employer, but whoever is hiring you, the so-called payer here, and you're the recipient, is going to receive a 1099 miscellaneous form. And here in box 7 is the amount, gross amount they had paid to you during the year. And they're not going to withhold any taxes. They're not going to pay any Social Security taxes for you. So you got to do that on your own. So you got to make sure the classification of the hired party is correct, either as an employee who's going to get a W-2 at the end of the year or an independent contractor receiving this 1099 miscellaneous form. So in either case, that income is going to be reported here on the taxpayer's 1040 form. And from the W-2, here is the W-2 income as an employee, or if an independent contractor treated as a sole proprietor in this situation, they're going to prepare a Schedule C, and minusing out the deductions also on Schedule C would leave a net income over here that's reported on the 1040. In either case, the income is going to be taxed. So here's the taxable income, and then we'll figure out the tax in the next line. But in the case of the self-employed, that independent contractor with that Schedule C, they're going to have to pay this self-employment tax. Here is the Social Security tax, the Medicare tax a self-employed person has to pay. Whereas the employee with the W-2 already paid it, at least their share out of the paycheck as a withholding. So you got to make sure again that hired party is classified correctly. A lot of employers are tempted to treat their hired employees as independent contractors, giving those independent contractors a headache with this additional tax in addition to the regular income tax. If you're an employee, probably you've already paid income taxes withholding coming reported on your W-2 form. If you're an independent contractor, then you should be paying on your own through what they call estimated tax payments. Here's a Schedule C that the independent contractor would have to fill out. And here would be the income, and they get to minus out all of these deductions off the top to leave a profit. And this is the profit that would be reported on the 1040 form. Now, if you're an employee that also incurs business expenses, you don't fill out a Schedule C like the independent contractor. But what you would do is report your employee business expenses on a form number 2106. And we'll get into the details in a future slide, yeah? But this bottom line here for the employee business expenses is going to be treated as an itemized deduction here on a Schedule A. So if you don't claim itemized deductions but the standard deduction, you cannot claim employee business expenses. Another drawback of employee business expenses is that you have to reduce the total down here by 2% of the taxpayer's adjusted gross income, leaving a smaller amount to be added in the total of the itemized deductions. And we learned in the previous chapter that we would compare this total with the standard deduction and take the higher amount. So if you're not itemizing but taking standard, then you're wasting your employee business expenses. Here again is that self-employed profit. Now, not just income tax, but the Social Security tax. And that's going to go up to right here, 15.3% of the business income. Okay, so that's a big hit if you're treated as an independent contractor, a self-employed taxpayer, as compared to a person receiving a salary or wage as an employee. We have, again, two ways of deducting expenses. One is to take a deduction to arrive at the adjusted gross income number. Basically, that's trade or business expenses, that's Schedule C expenses, or here, production of income. This is as a landlord. It mentions here reimbursed employee expenses if it's from what they call an accountable plan. An accountable plan basically says you're going to receive reimbursements, and then you're going to minus out those expenses that match that reimbursement. So basically it has no effect on the adjusted gross income. Again, that's for accountable plans paid by an employer to an employee. Now, other types of employee expenses have to be reported as miscellaneous itemized deductions, as I showed you on that form 2106. And most unreimbursed ones will be claimed there. Also, any investment expenses will be claimed there. Medical expenses don't belong here. Medical expenses isn't itemized deductions, but in these cases here, including tax preparation return fees, all of that miscellaneous expenses, you have to reduce it by 2% of the taxpayer's adjusted gross and then claim as an itemized deduction. Of the two different groups, this one is better because, again, it reduces adjusted gross income. So let's say that we have an employee that is going to be reimbursed by the employer. So we have expenses here. The employee is going to give receipts, give a report to the employer and get a reimbursement. So if this is a requirement of the employer to give what they call substantiation, proof that the employee had incurred those expenses. This will be income. Okay, you're going to add that to income. And this will be an expense offsetting that income. So the end result is that they cancel out each other. And in a real return, you would not report any of these two items on the 1040 form. Okay, even though again our textbook and the law says the reimbursement is taxable and this is a deduction for AGI, because they offset each other, you don't report anything because you're still left in the same place claiming zero income or zero deductions. Now, if you have excess expenses over the reimbursement, then you would treat it over here as a unreimbursed amount. If you have excess reimbursements over the expenses here, then the excess reimbursements has to be treated as income, probably reported on the W-2 form as additional compensation. Now, if you have unreimbursed expenses, then you have to report them on that form 2106, and then you transfer that total over to a Schedule A. Um, on this Schedule A, you gotta reduce this miscellaneous type of deductions by 2% of the taxpayer's adjusted gross income. So you can't claim all of those deductions, all of that costs. So let's take a look at different types of employee expenses or business expenses. Let's talk about travel. Travel is when you incur costs away from your tax home. Your tax home is not your residence where you live. Your tax home is the area, maybe the city, or at least let's say here on in Honolulu or Oahu. The whole island is your tax home. And if you have to be away from your tax home, then that cost to be away is a deductible travel expense. Again, make sure you understand what tax home is. Yeah, it's not your residence. It's the general location where you work. Yeah, where your office is, and you consider it like the whole town, the whole city. In our case here in Hawaii, the whole island is probably your tax home. And only when you're away from that island, that city, that geographic area, the cost you incur away for business now, business related, is a travel deduction. So how can you tell you're away for a temporary period? This is when it's a travel expense, yeah, deduction. It's temporary versus indefinite or an actual move, permanent move away from your old tax home. Typically, if the travel is less than 1 year, generally now, yeah, uh, that cost incurred away from your tax home is a travel expense that's deductible. If you're going to be working away from your home for more than a year, then the cost you incur right away at the new location is not a travel expense, not deductible as a travel cost. In fact, if it's a permanent move, maybe you get to deduct a moving expense and not a travel expense. Okay, so there's some subjectivity here in terms of temporary. Could be uh, maybe more than a year with other circumstances added in, or could be indefinite if it's less than a year, again, based upon the facts and circumstances. But this is just a general rule. Less than a year, temporary, deductible travel expense. More than a year or permanent, no travel expense. Maybe um, a moving deduction, not a travel deduction. So there are limitations in travel, especially if it's outside of the country or it's for general type education. The example in a textbook is a foreign language teacher taking trips outside of the country to learn more about the culture and language. That's too general to really be directly connected with someone's business or profession. Yeah, so that's not allowable deduction. And luxury type of travel, there's limitations in the dollar costs you can claim, including the cost of cruise ships. Now, if you have a mixture of business and pleasure in your travel, let's call that personal. If the main reason for the travel is business, then probably all of the airfare is deductible. Let's say the round trip airfare from your tax home to the travel location and then back again. But if you're at that new location and you spend some days on sightseeing and being a tourist, those days are personal, and the personal costs during those days, like the lodging and the meals, are not deductible for those days. But again, if the main reason for the travel is business, then all of the airfare and the cost for the business days are travel expense deductions. So you got to make sure you separate the cost for the non-business and business days. Now, if the main reason for the travel is personal and you spend some time doing business, then none of the airfare is deductible, and only the business days costs of lodging and meals and incidentals would be deductible. So let's say that, well, we shouldn't call this tax home. Again, tax home would be the general area where you work, but your residence, and you have to commute to work. Commuting costs is not deductible. Typically, it's driving. Yeah. Here's your second job, commuting from home. Non-deductible. But if you travel, really it's transportation. Think of transportation as local movement, yeah, local transportation. If you drive from one job to another job, this is deductible. If you drive from a job, your office, let's say, to a client's office, to a supplier's office, all of this is deductible transportation expenses. Again, but if you move back and forth between your home and your business, that's commuting. Now, let's say that here is a client's office over here. And instead of going directly to your office in the morning, you drive to your client's office. This is not considered to be commuting. Yeah. This is not a permanent office like over here. So this is deductible, the cost of this transportation. So how do you deduct that driving cost? Most time it's our automobile that you're driving. And there's two different methods here. One looks at the actual dollar amount incurred. We're going to learn depreciation calculations in our next chapter, chapter 10. So if we see something here in chapter 9, probably it's going to be given to us. So the gas you paid for the year, repair costs, insurance would be a big fee, registration license fee, you add them all up and the total costs. Now this would be deductible if you use your automobile 100% for business, but you also probably used it for commuting, which is non-deductible, or personal driving, yeah, to the market to drop off the kids at school. So what you got to do is have a log keeping track of all your business miles. It's called contemporaneous records, where you have to keep up daily how much you're driving for business purposes. Yeah, not just the miles, but the destination and business purpose of where you're driving to. So you would multiply this total by a fraction where you have the total miles as the denominator, total miles for the year, and the business miles as the numerator. So what you get here is the deductible cost based upon this actual method. Now, instead of keeping track of all the receipts and costs throughout the whole year for these items, what you can do instead is, again, keep that a log for your business miles, this number here, and you can multiply it by 53.5 cents for at least the 2017 tax year. So that's going to be now an alternate to this actual cost here. But in addition to that mileage costs, any business type parking, we don't have tolls in Hawaii, and auto loan, um, we don't have personal property taxes in Hawaii, but this interest will be based upon this ratio here, yeah? So this estimated standard mileage method is one way to take a deduction and possibly simpler than the actual method. Now, you can choose which method you want to use, but probably once you pick one method, you should probably stick with it, because if you convert to another method in the following year, there's some limitations and maybe some adjustments you have to make. So it's probably best to stick with one of the methods once you adopt one of the two. So let's have meals away when you're traveling, or entertainment anywhere, yeah? So this flow chart, let me just go through the highlights here. That cost has to be business, trade or business related, or production of income related. If it's personal, it's not deductible. And is that meal or entertainment directly related to your business, or connected, here called associated? Directly would mean that you're talking business right over lunch or dinner. Or let's say that you have a business meeting and right after that you go out to lunch or dinner. That's associated. Otherwise, it's not deductible. Yeah. So do you have proof, receipts, who, what, where, when, and why, basically, you're documenting? If not, the IRS says you can't deduct it. If it's rather small, maybe it's an employee lunch, employee appreciation dinner, a company picnic, then probably because it's so small, they say you can deduct the whole thing. Otherwise, if you're dealing with a client, a customer, you're entertaining them, then you only get to deduct half of that cost, half of that entertainment cost. If you pay to purchase or upkeep a entertainment facility like uh, a resort, maybe a health facility, or you pay employees club dues, that type of cost is non-deductible. But if you pay at the facility or club entertainment costs, those costs again are probably 50% deductible. Business gifts, not business entertainment, has a dollar limit of $25 per person you're giving to per year. A donee and the spouse and the family is considered to be one $25 limit. If you give more than $25, the excess is disallowed. There's other programs or dollar limits to other types of giving, especially to your employees here. Um, if the gift you're giving is more promotional in nature, like pens, something with your name on top of it, yeah, advertising, then it's really not a gift, yeah. Maybe I would classify that more as promotional advertising. Here's that accountable and not accountable again, yeah. So again, you're looking at the employer requiring proof to be turned in, and then the reimbursement given to the employee is going to offset the amount of expense. So on the employee's tax return, because the reimbursement equals the expense, you don't show anything. It offsets to zero. But if you have excess reimbursements, this is going to be taxable unless the employee returns it back to the employer. Employee returns it back to the employer. Now, if the employer doesn't require any proof and just gives reimbursements anyway, that's called a non-accountable plan. And all of the reimbursements is taxable income. And if the employer is handling it correctly, that income is reported as regular wage or salary income. Like sometimes you may hear, oh, a salesperson has an entertainment allowance, and they get that allowance no matter what, no matter how much cost they incur. That's regular income. You got to report it on the W-2 form. And then any cost incurred under this non-accountable plan is going to be treated as a miscellaneous itemized deductions reduced by 2% of the taxpayer's income, AGI. Keeping in mind again, meals and entertainment, you got to reduce that cost by 50% and then apply this 2% AGI reduction. Now, if the employer pays that reimbursement here, the employer has to also reduce that reimbursement being paid. Can't deduct the whole thing by the employer by 50% of that meals and entertainment costs that the employee had incurred. Again, an accountable plan requires the employee to turn in receipts and records to the employer, and only then the reimbursement is non-taxable to the employee. So you know what? If I were an employee, I want my employer to have an accountable plan. So when I get that reimbursement, it's not going to be taxable. If you have a non-accountable plan, I get a reimbursement, which I like, but now I got to report it as income, and any expenses I incur has to be treated as an itemized deductions reduced by 2% of my AGI. Again, here is that employee business expense form. And the big expense probably is related to driving here, yeah, the employee's vehicle. So a lot of that cost is calculated on the back side of the form here for vehicle expenses. So you have to put down information if you have, it's multiple vehicles here, yeah, the roughly the age, how many miles you drove during the year, how many were business, and we take a ratio, a percentage. Now this is that percentage we use for the actual method. And here's all the actual costs, including depreciation. In fact, this schedule here at the bottom is what we use for depreciation calculation. And we'll go through this next chapter, depreciation calculation. But the easier of the two methods here, actual versus standard. Standard, you can see just one line. You take the business miles here in line 13 and you multiply it by the annual rate. This 54 cents was for 2016. Again, for 2017, it's 53.5 cents. It changes every year. Sometimes it changes twice a year. Yeah, but for 2017, it's 53.5 cents. Then the total of the costs here is then reported back on the 1040 form. Let's see if I can get my pen back here. Here. And then other auto costs, travel expenses, anything miscellaneous, yeah? And you take a total. Keeping in mind, because meals and entertainment is half deductible, we put it in a separate column. Then we subtract out the reimbursements, leaving the net here. And if there's more reimbursements than costs, then the excess is taxable income, reported like a wage or salary. If we have excess costs, we take half of the business and entertainment and combine it with the rest of the others to get the grand total. And this is an employee business expense reported back on Schedule A as an itemized deduction, and again reduced by 2% of the taxpayer's AGI. Let's talk about not travel, not transportation, local transportation, but moving. This is semi like permanent airfare cost to get to a new place. Now to be deductible, you have to look at your old commute, yeah? From your old residence where you live to your old job location. And you compare that with your old residence again, but to your new job. So definitely if you're moving from the mainland to Hawaii or Hawaii to the mainland, you're going to incur like a thousands of miles here, yeah? But this distance here has to be 50 miles more than your old commute. Definitely if you move to or from the mainland. Probably if you move from one island to another one here in Hawaii. Um, Maybe if you move within one island in Hawaii, you're not going to get this 50-mile difference, and your moving costs would not be deductible, even though you're trying to avoid that rush hour traffic with that move. Once you make the move as an employee or as a self-employed taxpayer, remember that independent contractor, there's a limit you have to work, a time limit you have to work to be able to had claim that moving expense. The amount of the moving expense would be the amount of you physically moving, like airfare, maybe even driving. Although if you drive, it's going to only be 19 cents per mile. And the cost of, I guess, hiring a movers, yeah, to move the stuff you own. You cannot deduct um, some of the costs mentioned here, including any pre-moving costs, like house hunting costs before you made the actual move. This move here is the last time you move, the cost of moving yourself. The cost of moving um, is a 4 AGI deduction, okay? Not an itemized deduction. And you got to report it on a form 3903. So here is the cost of moving the stuff you own. And here's the cost of moving you. Again, this is moving your tax home, right? Your residence, and not business travel. If you do get a reimbursement, you have to reduce that, yeah, reimbursement from your employer. Excess reimbursement, taxable. The leftover costs, deductible as a 4 AGI, right on the front page of the 1040. Let's talk about education costs. Education expenses can be claimed in lots of different places on our return. We'll see in our last chapter of the semester, probably the best place to claim education expenses is to calculate out the education tax credits, the American Opportunity and the Lifetime Learning Credits. Somewhat related to that is if you borrow money and incur student loans. Um, the interest on that loan is deductible like we saw in our previous chapter as a 4 AGI deduction. The general rule for scholarship is that it's tax-free income if you use it for qualifying education costs. Now, once you use that scholarship to offset that cost, you cannot use the cost as an education expense elsewhere on your tax return. Same thing if you receive educational assistance from your employer. Generally, that's a tax-free benefit, and any cost you use to offset that benefit cannot be used elsewhere on your tax return to reduce your taxes. Otherwise, that would be a double benefit. There's different ways of saving for education, educational savings. Of the two mentioned here, this qualified state tuition program, sometimes they call this a Section 529 educational savings account. Of this and this one, the better one is this 529 versus the Coverdell, which we'll see. I'm not sure why they classify it as IRA, but we'll see it in the part 2 of the video lectures. To be able to claim an educational expense as a deduction, not a credit now, not an offset to the scholarship, you have to meet this requirement here. It has to be related to your trade or business, including your job, to maintain or improve the skills you already need to do your job. Or here it says, if you already have a job and your employer requires you to get that additional training, or it's required by law, let's say, to maintain your certification, then it's going to be deductible, that education cost. But if the education qualifies you to enter into a new trade or business, like a lot of you are students, maybe you're not accountants, right? but you're getting an accounting degree, you cannot deduct your education costs because it's going to lead you to a new trade or business into accounting. Okay? Now, if you're already in accounting and you're taking classes to help maintain or improve the skills that you already need and do, then you can deduct it as a educational expense deduction. This one is a little bit tricky. The example in our textbook is, let's say you're in accounting and you want to become a certified public accountant. So you take classes to get you ready for the CPA exam. They say that it's not going to be deductible. It's kind of related to this. A CPA and an accountant that's not a CPA are two different professions, so that's not going to be not deductible. So you always try to move your or classify your costs up here. Yeah, you're taking the classes to maintain and improve your skills for the job you're already in, and that probably is going to make it deductible. This is the last type of cost in this part one video. So let's say you use part of your home, treat it as a home office. A lot of people work from home, but they cannot deduct the cost of your home. And the main reason why is that it's not the main place of your business. If you're an employee, your main place of business is your regular job site, where your employer is. Now, if your employer doesn't provide you with a office and to tell you just work from home, then it's for the convenience of the employer, then maybe you get to deduct it. If the place where you're working at home is a separate structure, like a shed off to the side, or a room in the building, in the structure that you use exclusively, no personal use, but all business use, and regularly throughout the year, like for meeting patients and clients or customers. Because a lot of taxpayers cannot meet these conditions, they cannot take any home office deduction. If you can qualify, that any cost that's directly related to that home office, like utility line right only in that office, or repairs and maintenance of that office, that would be fully deductible. If you have costs that's indirect that benefits the whole property, then stuff like this here, then maybe you need to take a percentage. That's maybe the business square footage over the total square footage of the house. And you use this ratio and multiply it by these costs to get and match it up with the direct to get the deduction for home office. There's an alternate way of claiming a home office deduction, and that's $5 a square foot versus the way I just had shown you in the previous slide. And here is the form 8829 that you have to fill out if you're trying to claim a home office deduction. So let's stop here and go ahead and continue into part 2 when it's ready of the video lecture for chapter 9.